Most people think business wars are fought in boardrooms with dramatic headlines and public battles that everyone can see. But the truth is, the most consequential competitive struggles in American business happen so quietly that by the time most observers notice what's occurred, the outcome has already been determined. I've watched this pattern unfold dozens of times over 7 decades in business, and I want to tell you about one particular story that illustrates something fundamental about how real competitive advantages are built. It's not the story you'll read about in the business press because it doesn't have the drama that sells newspapers, but it has something far more valuable, which is a lesson about how patience and rational thinking can defeat what appears to be overwhelming force. Back in the early 1980s, there were 2 insurance companies operating in the same regional market in the Midwest. I'm not going to name them specifically because the point here isn't to embarrass anyone or claim some special insight that only I possessed. The point is to understand a pattern that repeats itself constantly in business, and this story happens to illustrate it perfectly. One of these companies, let's call it Company A, had been around for about 40 years. It was steady, boring, and profitable in a modest way. The other, Company B, was newer, more aggressive, and had attracted significant attention from Wall Street analysts who were excited about its growth trajectory. Company B's management was convinced they had discovered a better way to run an insurance business. They had fancy computer systems, which in those days meant something quite different than it does now, but it was still impressive to people. They had marketing campaigns that were sophisticated for the time. They were writing policies faster than anyone else in their market, and their revenue growth was extraordinary, something like 30 or 40% a year. Now, if you looked at these 2 companies from the outside, the choice seemed obvious. Company B was the future. Company A was the past. The stock price certainly reflected that view. Company B was trading at a significant premium to book value, while Company A was trading barely above its book value, maybe 10 or 15% higher at most. The conventional wisdom was clear, and conventional wisdom in markets is usually quite clear right up until the moment it's proven completely wrong. What the market was missing, and what most observers were missing, was something that doesn't show up clearly in quarterly earnings reports or revenue growth figures. They were missing the fundamental economics of underwriting discipline. You see, Company A had a management team that understood something essential about the insurance business. They understood that an insurance policy is a promise, and the quality of that promise depends entirely on whether you've charged the right price for the risk you're assuming. This sounds simple, and it is simple, but simple doesn't mean easy. In fact, one of the peculiar features of business is that the most important principles are often the simplest ones, and yet they're violated constantly because they require discipline that most people find uncomfortable. Company A's underwriting standards were strict. If they couldn't price a policy at a level that made sense given their assessment of the risk, they simply wouldn't write it. This meant that in years when the market was competitive and prices were being driven down by aggressive competitors, Company A's growth would slow or even stop entirely. They would sometimes go years writing less business than they had the capacity to write, which from the outside looked like they were losing market share and falling behind. Company B, meanwhile, was doing exactly what the market wanted them to do. They were growing. They were gaining market share. Their management would go on these analyst calls and talk about their sophisticated risk models and their efficient operations and their plans for expansion. And it all sounded very convincing because it was delivered with confidence and backed up by impressive revenue numbers. What they didn't talk about much, or what they talked about in ways that made it sound less important than it actually was, were the loss ratios they were experiencing on the business they were writing. In insurance, the loss ratio is simply the percentage of premiums that you end up paying out in claims. If you collect $100 in premiums and pay out $70 in claims, you have a 70% loss ratio. That sounds fine until you remember that you also have expenses, which in insurance are usually something like 25 or 30% of premiums. So a 70% loss ratio doesn't leave you with 30% profit. It leaves you with maybe 5 or 10%, and that's before taxes. Now, here's where it gets interesting. Company B's loss ratios were running higher than 70%. In some years, they were running at 80 or even 85%. They weren't making an underwriting profit at all. They were losing money on every policy they wrote, but they were making it up, or so they claimed, through investment income. See, in insurance, you collect premiums today and pay claims later, sometimes years later. During that time, you invest the money, and the returns on those investments are part of your profit. This is called the float. And it's one of the wonderful features of the insurance business when it's done right. But here's the thing that Company B's management seem to have forgotten or chosen to ignore. The float is only valuable if it comes at a reasonable cost. If you're paying out more in claims than you're collecting in premiums, you're actually paying for the privilege of holding that money temporarily. You're running what amounts to a negative interest rate loan business. Company A, on the other hand, was consistently running loss ratios in the low 60s, sometimes even in the 50s when market conditions were favorable. This meant they were making an underwriting profit before they even considered investment returns. The float they generated didn't just come to them for free. They were actually being paid to hold it. This is the difference between a good insurance business and a mediocre one. And over time, this difference compounds in ways that are hard to appreciate until you've watched it happen. Every year that Company A generated float at a profit, they were building intrinsic value. Every year that Company B generated float at a loss, they were destroying value, even if their revenue growth made it look like they were building a more impressive business. For several years, this dynamic continued. Company B kept growing and Company A kept plodding along, and the market kept rewarding Company B with a higher valuation. But then something happened that always happens eventually in business, which is that reality reasserted itself. There was a bad storm season, nothing catastrophic, just a series of weather events that were within the normal range of what insurance companies should expect and plan for. Company B's loss ratios spiked. Suddenly they were paying out 110, 120% of premiums and claims. They had to start reserving more money for future claims, which meant they had to acknowledge that their previous reserves had been inadequate, which meant they had to restate some of their earlier profits. The stock price, which had been riding high on expectations of continued growth, dropped sharply. Analysts who had been enthusiastic started asking harder questions about underwriting discipline and long-term profitability. Company A, meanwhile, saw their loss ratios tick up a bit, maybe from the low 60s to the high 60s, but nothing dramatic. They had priced their policies conservatively enough that they had room for adverse developments. They paid their claims, maintained their reserves, and continued operating much as they always had. Their stock barely moved because the market had never expected much excitement from them anyway. But here's what was happening beneath the surface. Company B facing pressure from their deteriorating. Underwriting results had two choices. They could tighten their underwriting standards, which would mean writing less business and admitting that their growth strategy had been flawed, or they could try to grow their way out of the problem by writing even more business at whatever price they could get. They chose the second option, which is what companies in trouble almost always choose because it allows them to postpone the day of reckoning and maintain the appearance that everything is fine. This decision set in motion a dynamic that I've seen play out many times in many industries. Company B became increasingly desperate for growth. They started offering discounts that made no actuarial sense. They relaxed their underwriting standards further. They hired salespeople on aggressive commission structures and incentivized them to write as much business as possible. Revenue kept growing, but the quality of the business deteriorated even more. Loss ratios stayed elevated. The float they were generating was now costing them dearly. But because insurance accounting can obscure problems for a while, especially if you're growing fast, the full extent of the damage wasn't immediately apparent to outside observers. Company A watched all of this with a kind of calm detachment. They didn't match Company B's prices. They didn't panic about losing market share. They didn't launch their own aggressive marketing campaign to try to recapture customers who were leaving them for cheaper alternatives. They just continued doing what they'd always done, which was underwriting policies at prices that made sense and declining to compete for business that was being mispriced by the market. Their management understood something that seems obvious when you say it plainly, but is remarkably hard to stick to in practice, which is that in a commodity business like insurance, the only way to make e-money consistently is to maintain pricing discipline and let your competitors make the mistakes. This went on for about 5 or 6 years. During that time, Company B's revenue was perhaps double or even triple Company A's revenue. They had more employees, more offices, fancier headquarters, better technology. By every visible metric of size and growth, they were winning. But underneath, they were slowly destroying the economic value of their business. Every dollar of premium they wrote at inadequate prices was a small bet against their own survival. And because these bets were happening thousands of times a day across thousands of policies, the aggregate effect was significant, even if no single policy seemed like it would make or break the company. Then came a second wave of adverse developments. Some of it was bad weather again. Some of it was claims from previous years developing worse than expected. Some of it was the realization that their reserves had been inadequate for several years running. Company B had to raise capital. They did a secondary offering that diluted existing shareholders significantly. The terms were poor because the market by this point had figured out that the company was in trouble. Management was replaced. The new management team came in and did what new management teams usually do in these situations, which is take a big bath. They wrote down all the bad business at once, restated several years of financials, and announced a complete strategic reset. The stock, which had been declining gradually, now collapsed. Shareholders who had bought near the peak lost 80 or 90% of their investment. Company A, during all of this, just kept operating. Their book value per share had grown every year by a steady, unspectacular amount, maybe 8 or 10% annually. Nothing exciting, but consistent and real. The float they generally erated over those years at an underwriting profit had been invested conservatively, mostly in bonds and some stocks, and had compounded steadily. By the time Company B was in crisis, Company A's intrinsic value per share had roughly doubled from where it had been when this story started. More importantly, they had maintained and even strengthened their reputation in the market. Agents liked working with them because they paid claims fairly and promptly. Customers trusted them because they'd been around for decades and had consistently honored their commitments. These intangible assets, which don't show up on a balance sheet but are enormously valuable, had grown stronger while Company B's had been eroded. Now here's the part of the story that really illustrates the power of long-term thinking. After Company B's crisis, the market environment changed. Prices started to firm up. Other companies that had been competing aggressively had similar problems to Company B and either failed entirely or pulled back sharply. The industry as a whole had learned a painful lesson about the cost of undisciplined underwriting. Company A, which had maintained its underwriting standards throughout the difficult years, suddenly found itself in an enviable position. They had capital, they had a strong reputation, they had underwriting expertise, and they were operating in a market where prices were finally rational again. They started growing again, but this time they were growing in a healthy market where they could earn good returns on the business they were writing. Within a few years, Company A's market capitalization exceeded what Company B's had been at its peak, even though they were a smaller company by revenue. More importantly, the value they'd created was real and sustainable, not based on growth that was destroying value even as it was happening. Shareholders who had owned Company A through the whole cycle, which must have been frustrating at times when it looked like they were missing out on the exciting growth of competitors, had done extremely well. Not through any dramatic event or brilliant insight, but simply through the steady compounding of sensible underwriting and patient capital allocation over a period of years. I've always thought this story and others like it contain several lessons that apply far beyond insurance. The first is about the difference between appearing to win and actually winning. In business, especially in commodity or quasi-commodity businesses, you can create the appearance of success through aggressive growth and market share gains. Revenue is easy to buy if you're willing to sell below cost or accept worse terms than your competitors. The market will often reward this appearance of success for a while, sometimes for years. But eventually, the economics matter. A business that's losing money on every transaction doesn't become profitable through scale alone. It just loses money faster. The appearance of success, if it's not built on sound economics, eventually collapses. The second lesson is about patience and discipline. Company A's management had to watch competitors grow faster, get more attention, receive higher valuations, and probably recruit away some of their employees with promises of stock options that appeared more valuable. They had to stick to their underwriting standards, even when it meant writing less business and appearing to lose market share. This requires a kind of institutional courage that's rare. It's much easier to follow the crowd, to do what everyone else is doing, to chase growth because that's what the market seems to want. But the crowd is often wrong, especially at extremes. And following the crowd means you'll get the same results as everyone else, which by definition are average at best. The third lesson is about time horizon. If you're managing a business or investing in a business with a short time horizon, You're going to make decisions that optimize for near-term results. You'll chase growth. You'll take risks that might pay off quickly. You'll try to show progress every quarter to satisfy impatient shareholders or analysts. But if you're thinking about where a business will be in 10 or 20 years, you make very different decisions. You focus on sustainable competitive advantages. You build a reputation for reliability and fair dealing that will pay dividends for decades. You sacrifice short-term growth for long-term strength. The interesting thing is that the long-term approach usually ends up producing better results even in the medium term, but you have to be willing to endure periods where it doesn't look that way. The fourth lesson, and this might be the most important one, is about the power of saying no. Company A's competitive advantage wasn't some brilliant innovation or technological breakthrough. It was their willingness to walk away from business that didn't make economic sense. In a world where most companies are trying to be everything to everyone, where growth is pursued almost as an end in itself, the ability to say no is incredibly valuable. It keeps you focused on what you do well. It prevents you from diluting your resources on marginal opportunities. It maintains the discipline that allows you to survive difficult periods and take advantage of opportunities when they arise. Most people underestimate how much value is created simply by avoiding mistakes. When I think about this story now, decades after it happened, what strikes me is how predictable the outcome was. Not in the sense that you could have known exactly when Company B would run into trouble or exactly how bad it would get, but in the sense the underlying dynamics were clear from the beginning if you knew what to look for. A company writing insurance at inadequate prices will eventually have problems. A company maintaining underwriting discipline will eventually benefit from that discipline. The timing might vary, the specific sequence of events might be unpredictable, but the direction is clear. And yet, despite this predictability, the market got it wrong for years. Company B was valued as if their growth was sustainable and profitable, when the evidence suggested was neither. Company A was valued as if they were a declining business in a dying industry, when they were actually building intrinsic value every year. This gap between market perception and business reality is one of the enduring features of capital markets. And it's also one of the reasons that patient, rational investors can do well over time. Markets are very good at processing information and adjusting prices quickly to new developments, but they're not always good at distinguishing between real value creation and the appearance of value creation. They're not always good at appreciating the value of patience and discipline when those qualities aren't producing exciting near-term results. They tend to extrapolate recent trends too far into the future, both positive and negative trends. These inefficiencies create opportunities for people who are willing to think independently and take a longer view. The irony is that the skills required to identify these situations aren't particularly complex or esoteric. You don't need advanced mathematics or proprietary data or insider connections. You need to understand basic business economics. You need to be able to read financial statements. You need to have some sense of what creates sustainable competitive advantage in different industries. And you need to be patient enough to let events unfold. The hard part isn't the intellectual analysis. It's the temperament to stick with your analysis when the market is telling you you're wrong, sometimes for years at a time. Most people can't do this. They get uncomfortable holding positions that are unpopular or unfashionable. They want to be part of the consensus. They want to see immediate validation of their decisions. These very human tendencies, which are perfectly reasonable in most areas of life, work against you in business and investing. I've seen this same pattern play out in so many industries over the years. Airlines in the late 1970s and early 80s, where companies competed on price until most of them went bankrupt. Retail in various forms, where successful companies maintained discipline about store locations and inventory management while competitors grew too fast and destroyed value. Technology businesses where short-term growth was pursued at the expense of sustainable unit economics. The details are always different, but the underlying story is remarkably similar. There's usually an industry or sector where growth is possible and tempting. There are usually some companies that pursue growth rationally and others that pursue it at any cost. The market usually rewards the aggressive growth for a while, and then reality reasserts itself, and the value of discipline becomes apparent, often quite suddenly. What's interesting to me is that these less so. NS don't seem to get fully learned, even by people who've seen the pattern before. Every generation of business people and investors seems to need to learn them again. Perhaps it's because the specific circumstances are always different enough that people convince themselves this time is different. Perhaps it's because the people making decisions are often different from those who learned the lessons last time. Or perhaps it's simply that human nature doesn't change and the temptations of growth and the discomfort of patience are constants that will always lead some people astray. I think about this story sometimes when I'm looking at businesses today. The specific competitive dynamics have changed, the industries are different, the technology is more advanced, but the fundamental questions remain the same. Is this business creating real value or just the appearance of growth? Is management focused on sustainable competitive advantage or short-term metrics? Are they willing to say no to opportunities that don't meet their standards? Can they maintain discipline when competitors are being aggressive? These questions matter as much now as they did 40 years ago, and they'll matter just as much 40 years from now. The quiet business war between these two insurance companies wasn't dramatic. There were no hostile takeovers, no public feuds between CEOs, no dramatic courtroom battles. But it was consequential. One company built a sustainable business that created real value for decades. The other company chased growth until it destroyed most of the value it had created. And the difference between these outcomes came down to patient discipline versus aggressive expansion, rational decision-making versus following the crowd, and the willingness to do what made sense rather than what looked impressive. These are choices that every business faces constantly, and the cumulative effect of those choices compounded over years and decades determines everything. That's really what competitive advantage is, not some brilliant strategy or technological edge, though those can help, but rather the consistent application of sound principles over a long enough period that small advantages compound into something substantial. And by the time most people notice what's happened, the outcome has already been determined by thousands of small decisions made quietly, rationally, and with an eye toward a time horizon that extends beyond the next quarter or even the next few years.